Today we're going to talk about scalping, a high-risk, high-reward trading strategy that involves taking advantage of small price movements in the market. Now, before we get started, I want to make it clear that scalping is not for everyone. It requires a lot of discipline and focus, and it can be very stressful. But if you're up for the challenge and you have the right tools and mindset, scalping can be a lucrative way to trade. So, what are the rules for scalping? Rule number 1, use a fast execution platform. When you're scalping, you need to enter and exit trades very quickly, so it's crucial to use a platform that can keep up with the fast pace of the market. Look for a platform that has low latency and fast order execution times. This will help you get your trades in and out smoothly and minimize slippage. Rule number 2, keep your stop losses tight. Since scalping involves taking small profits on a frequent basis, you need to keep your risk in check by keeping your stop losses tight. This means setting your stop loss orders close to your entry price so that you minimize your risk on each trade. By keeping your stop losses tight, you'll be able to cut your losses quickly if the market moves against you. Rule number 3, use a trailing stop. A trailing stop is a stop loss order that is set at a certain percentage or dollar amount below the market price. As the market price moves in your favor, the stop loss order moves with it, so you lock in more profit. Using a trailing stop can help you maximize your profits on winning trades. Just make sure to set your trailing stop at a level that is realistic and gives the market enough room to move in your favor. Rule number 4, only trade the most liquid pairs. Liquidity refers to the ease with which you can buy and sell a particular currency pair. The more liquid a pair is, the more likely it is to have narrow spreads, i.e., the difference between the bid and ask price, and low slippage, i.e., the difference between the expected price of a trade and the actual price at which the trade is executed. Some of the most liquid pairs to trade are Euro to US dollar, Pound sterling to US dollar, and US dollar to Japanese yen. Rule number 5, use technical analysis. Technical analysis is the study of price charts and patterns to identify trading opportunities. Scalpers often use technical analysis to identify short-term trends and find entry and exit points for their trades. Some popular technical indicators that scalpers use include moving averages, Bollinger Bands, and the Relative Strength Index, RSI. Rule number 6, don't overtrade. One of the biggest mistakes that scalpers make is overtrading, or taking too many trades. Scalping requires a lot of discipline and focus, so it's important to only take trades that meet your predetermined entry and exit criteria. By being selective with your trades and not overtrading, you'll be able to keep your risk in check and avoid burning out. Rule number 7, stay up to date with market news. As a scalper, it's important to stay up to date with market news and events that could affect the price of the pairs you are trading. Major economic releases, central bank meetings, and geopolitical events can all impact the market and create trading opportunities. By keeping an eye on the news, you can stay ahead of the market and potentially profit from price movements. There you have it. We hope this video helps you to make money scalping the markets. We will see you in the next video.